Welcome to the 2014 Annual Review of the PACER Investment Fund. I'd like to start off first by introducing our management team. I'm Mary Grace Wills, and I'm responsible for the restaurant and retail sectors.
Amy Weinstein, Consumer Goods.
Ken Doolittle, Financial Sector.
Kimberly Sarrow, Industrial Sector.
Sarah Stellatilla, Healthcare Sector.
Rancho International Sector.
Okay, so let's talk a little bit about the fund. Our stated goal is capital preservation with moderately aggressive growth. And as we manage this fund, what our objective is we try to get an annual return within plus or minus 3% of the S&P 500. The risk level of the PACER fund has typically been that of the market, about the same. But this year, the managers decided that a little more risk in our fund was appropriate. So as we speak about fund operations, I think it's important for everybody to understand what the managers do to identify potential investments for the fund. Some of the research we perform is technical, where we look at prices, we look at price trends. We'll see if there's high prices, low prices, do we feel it's a good time to buy. Another area that we research is fundamentals, and this is where we focus on the financial soundness of a company. We'll take a look at its financial statements, the balance sheet, the income statement, and we'll do a little bit of analysis around that. Buffetology is another approach we use too, where we look for continued long-term growth with certain companies. So when a manager sits down and does this research, their next step is to decide to themselves, is this something I think I want to introduce to the rest of the managers? And basically they do that.
Nothing like making a quiet entry.
Basically they do that by preparing what we call a proposal form. And we discuss our decisions in the monthly meetings. And basically decisions are made. I'll discuss a little bit later, a little bit more in depth on the proposal form. But in our monthly meetings, we discuss the investments we think are good, and then collectively as a group we'll decide to make the purchase or not. So if you're ever curious to see what the PACER fund currently holds, we have a website you can easily visit. It's www.mupacerfund.org, and you can see our real-time holdings. It'll show you performance. It also contains our prior year annual reports, and just any other commentary that might be relevant throughout the year. And moving back to the proposal sheets, basically the proposal sheet is just like a unified approach that's a snapshot or a summary of all the research that the manager did that can be shared with the rest of the group in our meetings. And in addition to our group using them, Dr. Comstock also has his undergraduate students work on proposal sheets as well, and sometimes they get funneled to us to see if we would consider those for investment decisions, and I will admit we do use them. So the proposal sheet itself looks like this, and the page you're looking at right now contains a combination of the fundamental and technical analysis we do. The top section, where it's all numbers, is basically from financial statements, and we will pull this information from a source such as MSN Money or Yahoo Finance. And then the bottom section is kind of our technical analysis, where we'll look at the price trend to see how the stock's price has been moving. So basically that feeds over into the second page of the form, and it's basically a calculation sheet that gives us in a snapshot the financial ratios that we find important when making investment decisions. And you'll see that there's debt ratios that we consider, profitability like ROA, ROE, and profit margin. So we'll take a look at these for trending. Are they going up? Are they decreasing? Is it erratic? So collectively as a group, these are handed out during our monthly meetings. Everyone takes a look at this, and we can decide collectively, do we think this has fundamentally sound characteristics, and then is it priced right to buy?
So to look back over the year, did we achieve our goals? We did preserve our capital and experience some growth, but unfortunately we also underperformed the benchmarks. So yes and no to that question. We learned a lot. The market was swinging up and down every single month. So in this type of tumultuous environment, it's really hard to decide when to respond to a swing and when to wait, ride it out, and see what happens. So we had to make a lot of decisions based on that. And we delved further into risk than we had previously. And by the end of the year, we raised our beta from 1.06 to 1.33, which is pretty significant as we were trying to overcome some losses that we had experienced earlier in the year. And we continue to look at sectors as a whole and their returns and make sure that we are allocating properly where we thought that we would experience the most growth. And we also had to maintain a focus on fundamentals first. So when the market is swinging up and down that much, it's really easy to get caught up in news stories and single event spikes. And we just have to make sure that we're going back to the proposal sheets that Mary Grace mentioned, and we are focusing on the long term and not just on technical trends. So overall, this was the performance. You can see the purple is the year-to-date and the green is the standard deviation. So our standard deviation is slightly higher than the benchmarks. That was due to our increased beta by the end of the year. And we underperformed. We had 5.74% versus 11.39 and 10.4%. So overall, throughout the year, for 5 months we outperformed the benchmarks, and for 5 months we underperformed the benchmarks. The problem was in April we really underperformed by about 5%, and we were unable to get back from that. So at the end of the year we looked at that. It was our biggest problem area, and we did some further analysis. What happened? Why did it happen? Did we do something wrong? And how can we use this in the future? So as you can see the numbers there that aren't that great. We thought maybe we didn't hold them long enough. Are we responding too prematurely to the swing, and we're selling off stocks that we should hold until maybe the end of the year? So that was how far our analysis went. And the stocks that we sold them for a realized gain of $710, and if we had held them until December, we would have made $1,400. So, there was definitely some room for improvement there. But we continued the analysis, and we saw that if we had sold them after May, we would have had a 10 times better profit. So now the question is, how do you know to hold them for that month? How do you know not to hold them for 2 months? So we have to just look at the situation in the future and compare it to where we're at and see if we can apply this analysis that we've done. We also looked at, can we just go back for 1 second? We looked at the stocks that we purchased in April, because we purchased 10 stocks, and of those 10, 9 of them were increasing securities that we currently held, because we were focusing again on fundamentals in the crazy environment. And we picked stocks that we had already studied, we had experience with, and we were very confident that they would grow. So we purchased more of those, and overall we had a net gain. We're still holding 4 of them, so the net gain would be about $3,000. So although that month showed a loss of 5%, we're still pretty happy with the decisions that we made in the month. It wasn't up to the market performance, but it wasn't a 5% loss overall in the decision-making process, if that makes sense. So then, for the stocks sold in April, you can see that this is the baseline here of 0, and except for the First Cash Financial Services, which is the dark red, all of the stocks that we sold stayed at that baseline or went down extremely until October or November. So it would have been really hard to predict, that would happen 7 months later. So we quite accurately predicted the near future, except for the exception of First Cash Financial. And then for our stocks purchased, we had 2 that experienced losses, but luckily enough, Kihu we sold at the end of July for a gain. So that worked out well, and we did experience a small loss on iRobot. But other than that, all of the others finished well above the 0% threshold. So again, we're happy with our decisions overall.
Okay, as you can see here, we have a pie chart of our current holdings, also listed the percentage in each sector and the average beta of each sector. Now in 2014, the managers spent a lot of time and effort rebalancing the sectors based on performance of the sectors, based on trends we saw in each sector and the economic outlook. So in 2014, our focus was to increase the allotment in industrial and utilities, which you can see we accomplished, and we focused on decreasing our allotment in tech and retail and the retail and restaurant sector, which you see we also accomplished there. Moving on to a list of our current holdings by individual holding. You can see all of our holdings there in their end of the year value along with their beta. I'd like to point out our 3 largest holdings are Bank of America at around $30,000, United Healthcare at around $23,000, and also EMC at around $23,000. Moving on to our biggest winners and losers of the year, you can see we have Lowe's there at a little over 100%, United Healthcare around 85%, and McDonald's around 63%. And as for our 3 biggest winners, I'd like to point out that they are holdings that we've had for the long term, especially McDonald's we've had since the inception of the fund. 63% is a great return for a holding, however, that's actually down from what it has been in previous years. So that's all three of our winners have been top performers for us for a long time. Our three biggest losers of the year, Alibaba, Prosperity Bank Shares, and Netflix, they're all recent purchases as well. So the downturn is over a short time span, and we believe that these are profitable stocks in the long run, and we will continue to hold these. Now I'd like to talk a little bit about the technology sector. As you can see here, we're going to list our current holdings. We currently have three holdings: F5 Corporation, EMC Corporation, and Apple. Apple is another recent purchase, so it is down over a short time frame. As far as the technology sector for this year, we do have a solid outlook for it. We're looking to seek out innovative tech companies that focus on cybersecurity, which leads us to our possible future additions, namely FireEye, which is a cybersecurity company, along with 3D Systems and Google. And I'd like to point out that Google has been a long-term holding of the fund, a sizable holding as well. It got sold off recently due to a stop-loss execution, but we may look to consider getting back in. Moving on to the financial sector, you can see we have four holdings in the financial sector. Bank of America, Encore Capital Group, which is a recent purchase, Federated National, which is another recent purchase, and Prosperity Bank Shares. Those are our four current holdings. As far as the future for 2015 in the financial sector, interest rates may rise, which would lead to a decrease in consumer spending or a delay in consumer spending, decrease in lending, which could be a bad omen for the sector. However, we believe that there's growing stability in the financial sector, and this is actually one we look to add to in 2015 with an increased focus on safety, which leads us to the companies that are involved with safety, such as MasterCard and Hennessy Advisors, Inc. We look to expand the financial sector in 2015.
So for consumer goods, all of these holdings we've purchased this year, so there's been a lot of turnover in this sector. Amazon, Deckers, Keurig, Netflix, Nike, and White Wave Foods. Nike was actually a suggestion from the undergrads, which is doing really well. So Dr. Comstock's doing well with that program. And so some future outlook, more discretionary income is always linked with increased consumer spending, so that looks positive. And exports are likely to decrease maybe due to the volatility in the European and foreign markets and the increasing strength of the dollar. And then also just we're going to continue to look at the rise of the digital influence, and you'll see some crossover with Netflix and Amazon between the technology and consumer goods sectors.
We currently have 7 holdings in the industrial sector. If you look at the list, the top 3 are ones that we've held for prior year, and then the rest of them were added in 2014. Our top performer was Netflix, or not Netflix, NextAir. They had a 33.75%, followed by ChemCorp at 24%. Our worst performer, Our worst performer was Conoco at -42. We've actually had Conoco for a while, but unfortunately with the decrease in oil prices, they've dropped. But overall, the industrial sector has been really good for us, so that's why we've added quite a bit for that. For 2015, it's expected a modest year. The EIA, which is the U.S. Energy Information Administration, they expect a 5 to 10% increase in growth for the utilities. This is mostly in the natural gas, which is becoming very big. They also believe a growth in manufacturing production, and that's mainly because they expect a growth in energy and transport. 2 areas that we should definitely watch for is, 1, the oil prices. There's a lot of mixed feelings with that. Mostly feel that they're going to decrease for 2015. This can provide us a good opportunity to buy oil stocks at a low price. It's just a question of when they'll rebound, so we'll definitely have to keep an eye out for them. The second one is within the water utility sector. The water utility sector, they have to face the fact that their water pipes and sewer pipes are aging, and then by 2020, about 44% of them will be unusable because they'll be in such poor condition. So that definitely opens the question as to who's going to have to cover those costs and who will benefit from that huge project with replacing all the pipes. So it's a 5-year from now, but it's definitely something that we'll have to keep an eye on.
And for the healthcare sector, you can see we have 2 current holdings. We went through a transition this year. We had about 6 holdings in total. and obviously 4 we had sold off. We did some consolidation. United Healthcare has been a very strong hold for us, so we allocated more funds to that, and Biogen we purchased in November of last year. And for our future outlook, we're going to definitely keep an eye on the ongoing uncertainties with the Affordable Care Act. Due to the lessons learned from the implementation in 2010 and now a transition to a Republican-held Congress, there might be some additional changes that are going to occur. So we're going to keep an eye on those trends for long-term holdings. We're also going to look at an emphasis of preventative care and specialty drugs. With additional people, additional population being insured, the specialty care and preventative care are going to see an influx. And then we're also going to pursue secular companies, which are medical drugs and medical devices that people can't live without. So we're going to look at that also.
For international sector, we have 3 companies. Alibaba is similarly to Amazon. We just buy it in last November. Baidu is similarly to Google. And this company has support from Chinese government. HDFC Bank is a commercial bank in India. We also bought a computer virus protection company called Qihoo. We have already sold it. Future outlook, we will avoid Europe, Brazil, and Russia, and we will focus on Japan, China, India, and Indonesia.
In the restaurant retail sector, we currently have 3 holdings, Lowe's, McDonald's, and Best Buy. And the retail sector, we trimmed back based on the portfolio reallocation that we did, but I believe the sector is doing well right now. As far as future outlook for the sector, we expect it to be stable with moderate growth. Retail is expected to grow 3 to 4%, and restaurant about 2 to 3%. As far as retail goes, the fastest growing area in retail right now is online sales. So we've positioned ourselves, we're involved in Amazon right now, in one of our other, in the consumer goods area. What's also good for this sector is that discretionary income has increased, and when people have extra money, they would tend to spend it on restaurants and retail. But some things we have to be mindful of as well is that this will be the sector that's most impacted by the minimum wage increase. And the global economy also could pose a threat here because there are multinational companies involved in this area, and the global economy right now is not in the best position. So the future directions, as far as the economic and stock market outlook go, looking to the future, we're very optimistic. We feel that the markets will face some uncertainties and increased volatility. The indexes are expected to do well, but it's going to be erratic. We expect to see some positive months followed by negative months, so we expect to see a lot more volatility in 2015. We're in a strong U.S. economy right now. We're in the 6th year we're just beginning the 6th year of a bull market, so that's also a good sign. There are lower oil prices right now, and the U.S. dollar is very strong, and these 2 items combined tend to hold down inflation, so that's also a good sign for us. Jobs growth and increased wages, again, support additional consumer discretionary spending that consumers can spend. And right now, analysts are predicting that the market's going to perform average, so about 10 to 11% return. So that's also pretty good for 2015. Again, some of the wild cards that we need to consider is the Fed is considering increasing the interest rate, and that typically any interest rate increase does cause volatility in the market. The global economy, again, is a wild card. Europe is struggling. China is experiencing slow growth. So again, we need to see what happens globally as well. And there's also the potential for a market correction. We haven't had a market correction in a long time. Typically, a market correction can be a swing in a price 15 to 20% down. The whole market can drop. So we haven't seen a correction in a long time, so just something to think about. As for the Pacer Fund for 2015, as far as the fund investments go, we're going to still focus on fundamentals first. We always want to look at the strong companies, then we want to take a look at their prices, purchase if they're attractively priced for us, and make those decisions there. We continue to analyze the sectors, especially with regard to allocation, and where we see sectors that we feel are going to perform well in 2015, we want to allocate a little bit more to that, and then we'll make the investment decisions on the underlying securities to place in those. As far as the stop-loss strategy goes, we use this stop-loss to help protect gains in the funds, but it's also tricky to try to decide at what point do you sell off a security and do we miss the potential rebound. And we've witnessed that has happened to our fund in the past. So we want to put a little bit of a policy to our stop loss in 2015. We want to set some parameters. We want to maybe say we're only going to protect securities that represent, like maybe the securities that are over 15,000 where we have the most risk. And then instead of selling out the whole security at a certain price, we'll set tiers at what level. Maybe we'll divide it by 3 and say at this price we would let go of 1/3 of the holding. In addition, when the stop losses execute, we'd also want to look to see what did that do to our fund, what did it do to our sector allocations, and if we think we want to buy that security back, we want to do it quickly so we could get the rebound on the gain. So that's going to be a big focus for the team this year as well. Another area that we focused on in 2014 was beta. When I mentioned earlier in the presentation, we increased the risk of the fund in 2014. We want to try and catch up. So basically, right now, our beta is a little bit higher, giving us a little bit more risk with the hopes of getting a little bit more return. But when you're in when there's a potential market volatility, which 2015 may experience, higher beta may not work for us. So the group wants to continually monitor the volatility to determine if we need to possibly reduce beta. So that concludes our presentation. We'd be happy to take any questions you have.